Welcome to the deep dive. Today, we're jumping into the pretty complex world of asset sales and exchanges. We're pulling insights straight from the sources you sent over. Our mission, let's try to cut through the jargon,
Right.
and show you how dealing with taxes on these asset dispositions, well, it isn't just about compliance. It can be a really powerful strategic financial move. Think about it. What if you could sell a major asset, reinvest all the proceeds, and delay the tax bill for years? Let that capital compound.
That's exactly the power we're talking about.
Right.
I mean, the default rule is pretty simple. You sell, you get a gain. It's tax right now. But the real magic is understanding how to strategically defer that tax. It's almost like getting an interest-free loan from the government on the tax you owe, which lets you reinvest the full pre-tax amount. You harness that compounding power much more effectively to build wealth.
Okay, let's dig into the nuts and bolts then. We know gain or loss is amount realized minus your adjusted basis. Basic formula. But what are the subtle details here? Where do people get tripped up?
Well, amount realized often catches people out. It's frequently misunderstood. It's definitely not just the cash you receive. It also includes the fair market value of any other property you get back in the deal. And crucially, any of your debts, the buyer takes over. So imagine selling a property, you get $200,000 cash, but the buyer also assumes your $300,000 mortgage. Your actual amount realized, for tax purposes, it's $500,000.
Wow, okay. That's a big difference. Easy to miss.
Very easy, and it can lead to some nasty surprises come tax time. Then there's the other side, adjusted basis. That's your total capital investment. It starts with what you originally paid, sure, but it gets adjusted. It goes up for capital improvements, like adding a room, a major renovation, and it goes down for things like depreciation deductions you might have taken over the years.
So keeping good records is vital here.
Absolutely vital. Every single dollar of documented basis increase is a dollar of gain you won't pay tax on. Seriously, meticulous record keeping isn't just, good housekeeping. It's a core tax reduction strategy.
Right. Imagine realizing you missed a receipt that cost you thousands in extra tax. Ouch. Okay, so here's where it gets really strategic, I think. When you do have a recognized gain, the tax treatment depends heavily on how long you held the asset. If it's over a year, that's a long-term capital gain. And those are taxed at much lower rates, right? Like 0%, 15%, maybe 20%.
Exactly. Compare that to ordinary income rates, which can shoot all the way up to 37%.
That's a massive difference.
It is. It's a huge incentive baked into the tax code for long-term investment. It profoundly impacts how quickly your wealth actually grows after tax. And what's really fascinating now is moving beyond just calculating the tax into the toolbox of strategies you can use to defer it.
Yeah, let's talk about those tools. First up, like-kind exchanges, Section 131. That's a big one for real estate folks.
That's cornerstone, definitely. It lets you defer capital gains tax if you exchange real property held for business or investment for other like-kind real property. Key phrase there.
And the rules are pretty strict, aren't they?
Oh, incredibly strict. First off, it's only for real property now. That changed back in 2017. Second, the timelines are tight. You have just 45 days from selling your property to formally identify, in writing, potential replacement properties. And you have to close the entire exchange, buy the new property within 180 days total.
And you can't just hold the cash in between, right?
Absolutely not. That kills the deferral. You must use what's called a qualified intermediary, a neutral third party. They hold the proceeds from the sale and use them to acquire the replacement property you identify. You can't have constructive receipt of the funds.
Okay, so 1031s are powerful but require serious planning. What about other options, like installment sales? That sounds interesting.
Yeah, the installment sale under Section 453 is a great strategy, kind of a hybrid approach. It lets you spread your tax liability out over several years. You basically recognize the gain proportionally as you receive payments from the buyer.
Ah, so you're not hit with one giant tax bill in the year of sale.
Exactly. Yeah. And that's powerful for managing your tax bracket each year. You might be able to keep your income below thresholds for higher capital gains rates, or maybe avoid that 3.8% net investment income tax in any single year.
So it's about timing and managing the tax hit smart.
Very smart, especially if you don't need all the cash up front.
And the sources also briefly mentioned a couple of others.
Right. Things like involuntary conversion, Section 133. That gives you relief if property is destroyed, say in a fire, or condemned by the government. Lets you defer gain if you reinvest the proceeds. And also tax-free entity formation. Sections 351 for corporations, 721 for partnerships. These are fundamental when you're starting a business, allowing you to contribute assets without triggering immediate tax. Foundational stuff for structuring.
Okay, so lots of powerful tools, but it sounds like the details matter a lot.
That really raises the crucial point here. All these amazing tax benefits,
Yeah.
they absolutely hinge on strict compliance. The rules, like we said with the 1031 deadlines, they are intricate and, frankly, unforgiving. There's no close enough.
Which brings us back to documentation. Meticulous, up-to-date records of absolutely everything isn't just a good idea. It's basically the foundation for defending your tax position if the IRS ever asks questions.
And remember, the burden of proof. It's on you, the taxpayer.
So given all this complexity and the sheer amount of money that could be at stake.
Yeah, the sources strongly recommend this. For any significant asset sale or exchange, don't try to wing it. Consulting experienced tax counsel isn't just advisable, it's pretty much essential.
Right. Get professional advice. So, wrapping this up, what's the big takeaway for you listening? It means selling an asset doesn't just have to mean a big tax bill eating into your capital. With careful, deliberate planning, maybe some expert guidance, you can use these sophisticated tools to keep more of your capital working for you, enhancing that long-term wealth accumulation. Think about how understanding these rules changes things. A simple sale becomes a strategic move. It's a tool for building wealth faster, letting your money grow tax-deferred for potentially many years. So the final thought is, what could you do with that extra capital compounding for you, year after year? Something to think about.